market debt, in terms of the size relative to everything else in fixed income, there is a misconception that it is a small niche asset class. Actually, it is bigger than, say, US high yield, or even compared to other asset classes within fixed income. So it's certainly a big asset class. Investment grade sovereigns, as well as emerging market corporates, are roughly about 1.5 and 2.5 trillion. So it's a big enough asset class that has enough liquidity to be able to trade in and out of. From an emerging market debt standpoint, people also have the other misconception that they generally tend to think of emerging market equities, which is a very different asset class. The only thing they have in common is the moniker emerging markets, because emerging markets equities is predominantly an Asia asset class. Between China, India, Taiwan, South Korea, you roughly have 70–75% of the exposure. Emerging markets debt for sovereign countries has a maximum exposure of 5% for any of the countries, with countries like Mexico or Saudi Arabia being the top issuers. On the corporate side, actually, it's not even that concentrated, where between China and Hong Kong, you have maybe 10%, but it is very diversified. If you think of underlying exposures, it's large cap China tech, which is net cash, large cap Chinese banks, the big property conglomerates, so really up in quality. So very, very different in terms of that. And from a investor positioning standpoint as well, there isn't as much exposure to the asset class compared to even what it was, say, 7–10 years ago. So certainly from an asset class perspective and asset allocation, it is certainly one area that is worth looking at here and now. So if you think of the asset class itself, it is a very different asset class now versus even pre-pandemic, where through the pandemic you had a lot of defaults in emerging market countries, be it because of the pandemic or even because of the Russia-Ukraine war. But starting from 2024 onwards, you've had a lot more countries especially get upgraded from a ratings quality standpoint. The picture is similar on EM companies as well, but maybe not as strong a contrast that you see on sovereign debt. On the default side as well, the picture is a lot more muted and benign, where you saw defaults again rise because of the pandemic, because of the Russia-Ukraine war. From 2021 onwards, you had the China property default cycle pickup. But from 24–25, the default cycle is a lot more benign and more in line with long-term averages. There are, of course, a few idiosyncratic stories, but those are few and far. And then from an EM versus DM standpoint, the level of debt to GDP on the emerging market side is significantly lower, and that is not yet reflected in where the valuations are. Relative to everything else in fixed income, you still have very attractive yields, high single digits in this space. A few things. So to start off with, we actually look at emerging markets in a very different fashion compared to a lot of our peers. So what do I mean by that? We are looking for high conviction, contrarian ideas where we are fundamentally stress testing the countries and the companies that we cover to look for what can possibly go wrong. Most asset managers tend to look at, this is my thesis, if it goes right, this is the kind of P&L I can generate. We are looking at it from the flip side, saying, what can possibly go wrong? Look at some of the scenarios like, in the current instance, what happens if oil and gas prices drop because of some resolution, or in the case of other commodities, for example, gold, if gold prices were dropping, or for copper prices, what are some of the countries and companies that can withstand that low level of volatility? For sovereign debt, sometimes we will stress test these to say, if they do not have access to capital markets and they have debt obligations due, can they survive without going into restructuring? And that's from the fundamental stress testing angle. We're also doing scenario analysis where we're assigning probabilities and bond prices to come up with a quantitative and qualitative approach to figuring out, is there upside or is there downside priced in? We famously used these more recently with some of the elections in Argentina as well as in Brazil and in Mexico. And what we found is at different points in time, there was too much upside or potentially too much downside. And that's how we positioned our portfolios, such that we're avoiding that negative convexity that a lot of investors get exposed to. And in terms of how our analysts approach it, most asset managers will have analysts looking at companies and countries and covering those. Our analyst teams are fully integrated with the portfolio management teams, and they are coming up with conviction scores and alpha targets so that they are just as responsible for generating the returns that you have in our funds. And in terms of, I guess, the last aspect of why us, we beat the S&P 500 last year in an emerging market debt asset class, which is not the kind of return profile that you normally associate with fixed income.